In continuing the chat on superannuation, when we put it up in the Facebook group with a heap of questions, Johnny boy, there were a whole heap of queues that came up around self-managed super funds. So I thought we would take the time today to just share some details about self-managed super fund from a high level. I want to answer some questions. I want to put some context behind it. We're going to talk setup costs, buying a property, buying shares. We'll talk investment strategy stuff and the trustee responsibilities. How many clients do you get now that want a self-managed super fund to buy a property?
Not a lot, to be honest. And maybe we don't market ourselves as someone that specialises in that.
Yeah.
At the end of the day, you create a strategy for the individual and the buying entity can be different. So in essence, there's not a lot of change on our front when we're looking for property. Good property is good property, right? But in terms of specifically people reaching out saying self-managed super fund, I want to buy a property in it, a small percentage, and we'll obviously discuss why that may be.
Well, and one of the reasons in this current landscape, there's, 10 years ago, 15 years ago, all the banks were doing the loans, but they just wanted to get away from it because it was just too complex, too many tripwires. It's just a big pain in the ass if you're buying property in a super fund using a mortgage, effectively. It's a different story if you've got the cash there and you buy it outright. But look, we're going to talk self-managed super fund, talk to your questions. If you want to join the Facebook group, please remember to put that you heard Glen and John talk on episode 836B in the line item where it says, where did you hear about us? But we're going to get into it. This episode is brought to you by Sphere Home Loans. We are big believers in getting a mortgage broker for your next property purchase, for your next upgrade, for your next downgrade, for your next side grade. There are so many different variables that can impact the type of rate that you can get, the type of, or the amount that you can borrow, how much deposit that you need, all the things. You may as well go to someone who's in this mortgage world every day and they will not charge a fee. They will have a chat with you and present you with the options and do all the legwork for you and make sure everything is underway. So Sphere Home Loans, they can help you. Well, let's get right into it today. Self-managed super funds, let's go. You're listening to Money, 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 or as the regulars like to call us, M3. Everything discussed on the podcast is general advice only, which I'm licensed to give, and details can be found in the show notes. My name's Glen James, former financial advisor, now podcaster. I host this show and a show called Retire Right. I've also got a book called The Quick Start Guide to Investing, which you can check out wherever good books are sold, or there's a link in the show notes. Otherwise, thanks so much for listening today. Now on with the show. I will say at the outset that I nor John we are not self-managed super fund experts. This is a particularly complex field. It's particularly annoying to understand. Look, like everything in the money world, a solution will have a heap of opportunities and a solution will have a heap of red flags when it isn't for you. And it's just, I don't know. I heard someone talk about this the other day, John, and you know this person. I'll write it down and then you can read. They are buying a property, commercial property in a self-managed super fund, setting it all up via commercial property. And then they were telling me, I'm like, oh, sweet. Are you going to rent it yourself for your own business? And like, no, we're just going to do it as an investment. I'm like, oh, okay. Should I do that? And my first answer was no. Like, why would you? And we'll get to that. But I think we'll just start. Jack in the Facebook group, she or he, I don't know. The profile is Jack Aranda. So
Yeah,
which is a
I've
tree.
spoken with Jack before.
Right, so I don't know. I guess it's a woman because it's JAC. How do you know if you're ready for a self-managed super fund?
That's an interesting question, the way it's framed, because it's so like we're going to start a family. When are we going to start it, sort of thing? As though it's almost like everyone's doing it. It's just a matter of when. So maybe not intentional, but I think, we'll talk to the pros and cons of a self-managed super fund in general. But I think, first of all, why do we need to change? Why do we have to come from maybe an industry fund and say, I think I can do a better job myself?
And most of the time you can't. Because Mac actually said DIY self-managed super fund for ETFs. That was the comment that Mac made, where the last episode when we did the superannuation explainer, there's no way on the planet you would set up a self-managed super fund just to get ETFs, because you'll be able to dial in a very similar investment in your own retail fund.
And if you compare the fees percentage that you went through, it's going to be wildly different, isn't it?
Yeah, and we're going to do some fee crunching. But I think you said it at the start, John, it's particularly with this property thing, we'll ignore, because Jack might just be under this thing where it's like, well, at some point you become a financial grown-up and get a self-managed super fund.
Yeah.
You don't have to, but if someone was like, oh, we want to buy property in super because we want property, well, I think it is, okay, well, what property do you want? What's the asset? And then we work backwards. What's the ownership structure? Like it's not this, we've got to just buy property with our super, because I would hypothesize that buying one property with your super, and often it will be your spouse's super because you'll need to join the balance, is more risky than keeping your current super fund.
Yeah, and we'll never get a definitive yes or no to that because everyone's situation is different.
Well, you will. It's like one property worth X amount, one source of income, one property versus a diversified portfolio, Australian shares, international shares. I know what's high risk, and it's not the one property.
Yeah, I know. But
it's not like the other thing. The property is high risk.
But you could have a situation where there's a high cash amount in the superannuation, and I'm a business owner and I go and buy a warehouse to run my business out of, and it's just so called that the entity is my self-managed super fund.
And that's different. That's a different discussion.
And that's what I mean. It's dependent on the individual.
Yeah.
So like Jack's question might be, well, she's coming from the angle of I'm a business owner. Maybe.
Is she? Oh, you don't know?
Don't know.
Right.
But it's like, well, I see it most common for people that want to buy something to rent it off themselves as a business owner. But I also see property geeks say, well, I'm exhausted in my personal name and I just love property and I want more exposure to it. So hang on, I'll look around where else can I get a deposit? Oh, over here. Great. Yeah. My self-managed super fund, I can cash my $200K in, or not cash it in, but use that as a deposit. The only way I can do that in superannuation land is to create my own self-managed super fund. So, yeah, I get why people do it, and we just need to be aware of the cons, I suppose, of doing that, not just the pros of leveraging the bank's money.
Yeah, and my kind of overarching comments, you would look to a self-managed super fund if there was significant wealth, potentially, because we might be able to actually save money on fees, like legitimate savings there. You may have some complex estate planning needs. So remember last episode, everyone, when you are with your Australian super et al., or whatever the Latin is, and others, the trustee is part of that, where you might want to set it up so you are the trustee, so there is more discretion with the estate planning stuff, so it's harder to be challenged and whatnot. You mentioned it, commercial for business, that's fine. There's another thing as well which it's a rarity. You might want to invest in a company directly that is outside of the top 300 ASX. You want individual shares because I think a lot of these member select platforms on the retail funds will not let you invest outside the top 300 to 400. So you might work for a company that's listed and you want to buy in. That could be an option as well. I'm not against self-managed super funds. I'm against not doing things that you don't need to do.
Well, yeah, potentially jumping ship because something didn't go the way you wanted it to, and acting on potential impulse or short-term thinking.
The amount of people during the GFC with their super, they got spooked, particularly in their 50s, ran along to their accountant, they set them up with a self-managed super fund and it just sat in cash and term deposits for 4, 5, 6, 7, 10 years. It's just outrageous.
Yeah.
Because you've got to move it to cash on your platform.
Yeah, true.
But that's just a misunderstanding of super, investment options, and a way for an accountant to sell a couple of funds and some audit fees.
Well, and that's probably the other part of it too is like elephant in the room. There are specialists out there who may do this for a living, setting them up and benefit from them financially, regardless of whether it's suitable for the end user.
So how do you know you're ready for a self-managed super fund? I think it should appear itself. The need should appear. So for example, I use dumb analogies. These cameras here in the studio, they're cheap kind of entry-level crap, right? And they were good, and the more that we were using them and doing different things.
Shout out to Sony.
Yeah. We spent freaking $12,000 with Sony. But they are not – like once you get used to something and use it and you become more of an advanced or intermediate user of a product and this could be like super in your financial goals, you come to the limitations really fast of what you've got.
Yeah.
So these cameras, I'm like, all right, we've got to replace them. So I've just purchased 2 A7 4s with some good Sigma glass and all that, and upgrading because I've outgrown it. What I need to do, I could not do it with this setup.
Whereas if Walt Disney was still around, Walt Disney would walk in here and be like, "How good's this setup?"
Yeah, he'd have
99% of Australia would be comfortable.
He'd have an orgasm. But that's it. Like these do the job, absolutely. But we needed to do some more bespoke stuff that these cheaper ZVE 10s can't do.
Yeah. So another analogy that was good.
Love it.
So
health and fitness, go for it, bro.
Yeah. Well, I think I'm all about long term. Right, where do we want to be long term? I'm not going to use an analogy, but I think we've got to ask ourselves. No, I'll go back a step. We should be sitting down with our accountant each year and saying, right, here's how the last 12 months transpired from a tax perspective, from a wealth creation point of view. And as you said before, the conversations should lead that way. And they should be almost having conversations like you and I are now. It's like, well, okay, have we thought about a self-managed super fund? And the accountant says, yeah, well, these are the pros and cons of it. This is why you would, this is why you wouldn't.
I mean, I wouldn't go to an accountant for financial advice.
No, but that's where it starts.
Yes.
Like they're not setting it up and recommending it per se, but they're looking at it, the overall situation of your life, and then you're talking about wealth creation with your financial advisor in conjunction with that, and that's when you might start to come to the conclusion for Jack.
So let's get into some meat here, and then we'll go back to some questions. So if you set up a self-managed super fund, it could cost $5,000 to set up because you have to set up effectively a separate entity. Now, that entity, it will need a trustee. So that you're setting up a trust. Superannuation funds, they're trusts with the beneficiary or being set up for the purpose of the members. You can be the trustee yourself or have a corporate company trustee. I always recommend and suggest people have a corporate trustee. So it's a company. So it's going to be $300 a year just for the company fee. The company will act as the trustee, and the trust will have a trust deed. And the trustee's responsibility is to ensure that the fund is operated as per the deed. And if there are 2 people in a super fund as a member, or we can have up to 6 members, so you, your partner, and 4 kids, all could be members. Each member has to be a director of the corporate trustee. Within the fund, if 2 people put in $200,000 each, it's one super fund with $400,000, but in the background, like the episode we did last, there will be member statements. So one member, it will say your eligible service date, your taxable component, your tax-free component. It'll have all the components in there, and there'll be 2 member statements. And every year you have to do a tax return and pay for an external auditor to audit the super fund. The super fund world is regulated by APRA, the Australian Prudential Regulatory Authority. However, the ATO oversees self-managed super funds. Okay, so you will potentially pay up to $5,000 to get a fund set up. Could it be cheaper? Probably. Could it be more? Probably. This goes to where are you going to get that set up and who's setting it up for you.
Yeah. If it's more than 5, I'd start to ask questions though.
Yeah. Now, each year to do the financials, and remember, if you're doing crypto trading and heaps of transactions, this could be more than the run of the bear. It could be $2,500 to $3,500. I think my self-managed super fund, it's about $2,000 a year for the audit and the accounts. So
which includes the tax return.
That's right. The accounts are the tax return, and then so you need to set up this trust. It'll have its own bank account, and you basically it will need an accountant or a self-managed super fund specialist. I've got a specialist who pretty much just does super funds, and she does all the accounts for me. So it's a big deal. And for example, people are always like, well, how much money do you need? Well, you could set up a self-managed super fund with $10,000 if you want.
Yeah.
However, if you look at the year one cost, and we'll just call it $8,000, so the setup and the first year audit, call it $8,000. Now, the super fund will pay for that. You don't pay for it out of your own money. So we go back to $8,000 divided by $250,000 is 3.2%. So remember that last podcast where we looked at the platform fees with ART, for example. The first year platform fee for the super fund is 3.2%, where the fund industry or retail fund's probably 0.1%.
Yeah.
And this is before we even worry about investments.
Yeah, and that's where you mentioned before about the balance being critical when we're setting this up. If you've got $3 million in super and you decide to create a self-managed super fund, then the percentage is obviously relative to that.
Absolutely. Now, year 2, if we assumed there was $3,000 for the annual financials and audit, and I've done $3,000 divided by $265K, so it's grown from contributions, maybe a bit of growth in there, it's 1.13%, which, sure, it's probably okay.
Not bad.
But, if you want to invest in ETFs or a property, you've got your investment fees.
Yeah.
So realistically, you're really not entertaining it, I don't think, without 200 to 300K of combined assets in terms of just a fee thing.
Yeah, and you're not doing it in the initial stages to save on fees.
No, you're doing it for a purpose. And I will say as well, one of the benefits of using a self-managed super fund, but you can get this benefit in a wrap account. And again, we'll share the link to the wrap account where I went through in details because the concepts are the same. When you're moving to pension mode from accumulation, In Superland, with all your industry funds and all your, those type of unitized trusts, they've got to actually sell down your assets and buy into the pension pool. So you will pay tax. So it could cost up to 0.8% of your account balance at the time. So if you had a self-managed super fund or a wrap account and you're accumulating wealth from age 30 or 40, when you get to pension phase, there doesn't need to be a physical sale of those assets. It's a paper entry, effectively. Yeah. Okay. So there are some absolutely tax reasons with significant wealth, but you can get most of the stuff that you want to do with a self-managed super fund nowadays, you can get with a wrap account, with some exceptions. So what about we now go – we'll take a break, and when we get back, we'll go through a property example, buying it in a self-managed super fund. We'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au. And they'll point you in the right direction.
So what was your reason for setting up a self-managed super fund?
Because I bought this unit in there.
So your sole reason was to say, I want to buy a property, an asset that is property, whether it be commercial or resi. I'm going to forgo what I've got in a normal industry fund and take that across because of your business, wholly and solely, or potentially with the results it could give you?
Oh, look, I think I wanted to, because I had a decent super balance, and for my life stage and age and what I needed, it was just a better use of my super to buy a commercial unit. And so basically now my company rents off my super fund.
Yeah. So there's that side of things. If you weren't a business owner, would you have done it?
Well, I wouldn't have, no. And that was like old mate that I was talking about before. They're buying a commercial property in their super fund, and like I'm just not doing investments like that in my super fund.
Yeah.
Like,
do you look at it and say, okay, I've got let's say this costs $200,000. Do you look at it and say, well, now I've leveraged that amount. I've got $200K of real estate here that if it performs at 5% or 7%, then that's better off because I've still got my cash amount in my super that I can invest as well as the asset?
Yeah, so what I want to show you, John, is with borrowing, I set mine up so I put a higher deposit in so the rent would cover the P&I repayments and a little bit more.
Yeah, which is common.
However, the example we're going to use, it's very interesting. And I will say a couple of flag markers. With self-managed super fund, you can't buy a property, a residential investment property, and live in it yourself. You can't have your kids live in it, your parents live in it, your cousin live in it, any related party you can't. If you've got an existing residential property, you cannot sell that to your self-managed super fund. However, if you've got an existing commercial property, you can move that into your self-managed super fund.
There's lots of no-goes for property types.
So the assumption that we've used, and I might actually share this for those who are watching it on YouTube. I'll just make sure so if you are watching on YouTube, you've just seen my really primitive workings. Oh, you won't need to see that, John, because you can see it there on your screen. I just loosely crunched this in Word and we'll read it out. So the purchase price, $700K for a property. We need to set up a separate trust because the way that the super rules are, the super fund can't borrow money effectively. So you have to have a trust that borrows the money, and it's effectively a second entity that's set up. So I've got a self-managed super fund with a corporate trustee, and the Bear Trust is another little trust with a company so all this crap just adds up, right?
They're one-off fees initially.
They
like
are.
The Bear Trust, etc.
Yes. Yeah. And you don't need to do an annual financial audit on the Bear Trust.
No.
So assuming a 20% deposit, you're going to need 140 grand of meat.
And some banks, and again, there's not many banks left that will actually loan.
No, they're
this,
all
but
kind of third-tier lenders now.
yeah, so some actually require 30%, to get a better interest rate as well.
That's right. And there's generally as well, it's a bit of a, you want the money, you pay. Like,
Yeah.
you can see here, the interest rate's over 7%.
Yeah.
So it's going to be a couple of percent more, could be up to 3% more. Now, the stamp duty will be $30,000 and you wouldn't borrow that, and, a couple of grand for legals. So based on a $560,000 loan, and the loan's called a LRBA arrangement, limited recourse borrowing arrangement, which basically says it's limited recourse. So if your super fund stops paying, the bank can't go after the other assets within the super fund. And the dumb thing is, the bank or the lender will make you sign as a director for liability, which is odd, but sure. So they'll come and get you. So if we have a look at the balance required, $140,000 plus 30 grand stamp, maybe some setup costs of $3.5 grand, you're looking to knock on the door of a $700,000 property, $173,000. Okay.
And just to add in there that the stamp duty is going to be different in each state.
That's right. We
So
just used a bit of a...
New South, exact is 26.
Right.
But Victoria is 39. So it's, we've gone somewhere in the middle a little bit.
So let's have a look. A loan, 30-year term for the 490 here we go, 20% deposit. So the loan is 540, 30 years. We'll assume 4% gross rental yield, but I've just assumed $3,000 for agency fees or any dickery throughout the year, Johnny. So the loan repayment on itself is $44,000 P&I, which you can't get interest only. Mm-hmm. So there's a whole of $17,000. Does that make sense?
As a shortfall?
Yeah.
Yeah.
Now, if you increase the deposit to 30%, you'll need $210,000, because this is where you start playing with the cash flow, and that's why I put a higher deposit in. If the rent was 25 net, the loan repayment's 40 now, not 44,000. There's still a neg 15K a year difference.
Yeah.
So the question is, where is that difference going to come from?
Yeah.
Now, sure, it could come from your superannuation guarantee payments, so your employer contributions. But between you and your partner, if there's two of you, do they net at, after contributions tax, of 15 grand a year? Not sure.
Well, and you ideally want the super contributions to be growing your cash amount, don't you? Not
That's right.
just covering your holding costs.
Yeah.
Because the tax situation is different inside super versus if you had a negative 15
That's right.
in your personal name.
So, for example, it moves you into negative gearing territory because you can still, quote unquote, negatively gear in the super fund.
Yeah.
But it's only because the tax rate's 15%.
You can only claim at 15.
Yeah. So a couple of things here. You can't use equity. You can't, can't do that. You can't, we talked about living it. You can't renovate it with your own money. So you can't be like, oh, we're going to put a balcony on the back. I've got 30 grand that I won on the pokies. I'm just going to put that 30 grand. No, that's a contribution to super, number one, because it's in super. So you can't do that. You can, for example, use cash in the super fund to do maintenance and minor refurbishment. So we're going to do the kitchen or the bathroom. You can't refi it and cash out and get equity and do a knockover rebuild. Like, it's a one and done.
Yeah. So what you're saying when you say you can't use equity, if your asset of 700K grows to $1 million and you've got a loan of 500, then essentially in your personal world you would have
you could borrow 400,
300K at least to take out and go and do what you want, provided the servicing was there. You can't do that in your super. You have to sell the asset, keep it in there, and then buy again, and basically trade one for one.
Yep.
And the other part of this is you can't have a two-part contract.
No.
So it's got to be one
You can't build
contract.
a property, You can't build a house and land and then the land. Another thing as well, and I'll get you to speak to, the house and land, one cost that, and this is because there's probably 3 or 4 lenders who actually do this now in Australia. When you go and get a mortgage, the bank will send out a valuer and pay for it and all that. A lot of the times you're paying your own valuation.
Yes.
So these lenders, they're not
1,000.
like, I'd had to pay, I think, $3.5 or $4 grand for this. I'm like, give me a break.
Yeah.
So
for evaluation.
it's not as if you're refinancing every year because of the costs involved.
Yeah.
So if you're buying a property with your super, you want to make sure that's the property you want. You want it long term.
Yeah.
I just think there's more reasons not to than to.
Yeah. There's a lot of I suppose, rules and regs that you just don't have in your personal name. And if you're a property head and you want to take that over into your superannuation, you've just got to really just know the pros and cons and not be sold a sizzle by someone that really just wants you to set that up.
Yeah. And we'll also add, if you're buying a commercial property, if there is a tenant in that property, it's called a going concern. That means you don't have to pay GST. However, if there isn't a tenant in that commercial property, and this is the same inside or outside super, if there isn't a tenant, you'll have to pay the GST. Now, the trick and the problem is you can't borrow the GST. So if this 700K was a commercial property, and there wasn't a tenant in there, or it was a new off the plan or whatever, you need an extra 70 grand to cash flow the GST.
Out of your own pocket that you can't lend.
Not out of your own pocket, but out of the super fund.
Out of the super's pocket.
That's right. Now, I haven't seen this in a while, but depending on the lender that you use, some of them will require a 10% liquidity of the property value upon settlement. Which means property settles, 700 grand, you need 70K.
Yeah.
Because the thing is, you've got responsibilities as trustee. You need to pay the contributions tax, needs liquidity out of that. The bank probably want it more so they can get their repayments as well.
But you could claim the GST back.
Yes, if your super fund was registered for GST, yes.
Yeah. So it just for the listeners, it's not 70K down the drain, never to return again.
No, but speak with your tax professional on that.
There's a lot of hoops to go through.
Yeah. So, but you still need to cash flow it if that's the case.
That's right. Absolutely.
So the new home trap, 10 years ago, it was rife where you'd go to the property seminar and the next minute you walk out with a self-managed super fund, a mortgage, a brand new property, turnkey in an estate. Happy days. What could go wrong? We're not seeing it as much now because I think it's harder to lend because not every bank does this.
Yeah, I don't know if COVID got in the way of that or not, but I don't know what's
I reckon the money was
happened
harder.
in that space,
It got
but
more complex.
the lending's definitely tightened since GFC, no doubt about that. So that was, 14 years ago. So definitely since then, less of that we see happening anyway. But yeah, the fact is there's still a lot of new homes getting built. There's no doubt about that. But we don't hear a lot of it being in there in the self-managed super fund.
But the problem with this racket that was going on, it was the one-stop shop that had the accounting arm, the finance arm, and the property arm. So the accounting arm, they got $5,000 and probably a couple of grand a year extra work, tick. The broker arm got their $4,000 or $5,000 mortgage commission, tick. And none of these are bad things on their own right.
It's just the one-stop shop.
And then the property arm, I can tell you someone was getting $30,000 under the table not disclosed as well. And you were in an estate that was oversupplied, the yield was not there, and it was just a complete debacle.
Yeah, especially if the last part of, the asset actually isn't performing for us and it's oversupplied and I've got vacancies and I've got holding costs that I wasn't explained were going to be there because all of the sell was the positives of it and how it can look like in 10 years' time when you retire.
So if we go now to Jessica.
Yeah, Jessica, is it worth changing from an SMSF to a retail fund once you've already retired? For example, there was a business originally, which is why there was a SMSF, and now there isn't. How hard is it to change?
Yeah, that's probably a good flashpoint. Everything that you can get with the self-managed super fund, the 90% of the things, except, maybe some property or real crazy speculative stuff, you can get on a retail platform. So go to an advisor. I've wound up a heap of super funds for people over the years. It's not hard. It's a bit annoying. But, if you're going to retire, you want probably less paperwork and less drama, I would think. So that would be and that's interesting, John, because the need was there when you wanted a commercial property.
Yeah.
Things were lean in the business in our own name, but there was meat in the super fund. Well, let's just do it there. We'll rent it off the super fund, and it's got to be market rates. You can't underpay or overpay, so you've got to watch that.
But you'd also look at that.
But if the need was there, so we went to self-managed super fund. Need's gone now, so in theory, we don't need to self-manage.
No, but is it still a good investment? Do we have to upset the apple cart? Like as in business is no longer there, but can we rent that out and is it still a viable asset and investment?
Well, I think you run into the liquidity thing. That could be all they've got and they need to retire, so it has to be sold because they can't live off the rent.
And draw down some of the,
Yeah. And that's the thing, like once you get into your pension phase, there's minimum drawdowns required from the super fund. So it's all well and good to have the property, but if you retire and you've got to pull 5, 6, 7% a year and it's not coming from rent, you've screwed. You've got no liquidity. You've got to sell.
Is that what it is, the minimums?
5,
5%,
it starts at 5. Yeah.
Of the total balance. So how hard is it to change? Not really.
No, it's not hard.
Vanessa.
How to best structure an investment strategy in a self-managed super fund. We just set ours up and have invested in one property so far. Now looking at what we should diversify and split between high growth and defensive. Yeah, so part of the responsibilities of the trustee is to ensure that the fund has an investment strategy. So it's a document that says this is the fund, this is how we're investing on behalf of members. It will have cash, 0 to 60% at all time. Australian shares, 0 to 60%. International shares, 0 to whatever. So this is the band. I did my own, it's so funny, I did my own strategy, sent it in the first audit. They didn't use it. They plugged in some template or it was a mistake or whatever. And it was pretty much like just all for property. I'm like, you people. So
you need...
What you've got to look at the answer isn't just property to everything. Like, share your experience. Why don't you have a self-managed super fund, John, and why don't you own property in it? Because you're the property guy.
Well,
shouldn't you get property everywhere?
there's a couple of things. First one is being a business owner. I think I shared this in the last episode. Being a business owner, my superannuation contributions were low for a period of time, and not only me but my wife. So the balance wasn't adequate to say let's go and buy a $600,000-$700,000 property. So if the balance isn't high enough and you can't buy an asset that's worthy, then why would you do it is probably the first thing of that. And then the second one that always was putting me off was the fact that, the interest rates are high, the restrictions are there, you cannot do a lot of things that you can do in your personal name. So why wouldn't we just continue to build it in our personal and let superannuation do its thing? But from a diversification point of view, I've got to have some superannuation or I've got to have some investment in some other asset classes because we're so highly geared into property in our personal.
Yeah, and that's what I mean. So to Vanessa, I would hope potentially, so in my situation, I've got the property, there's a little mortgage in there, I've got lots of cash in there, and my contributions now go into, and I've shared this before, the Life Sherpa Invest has a portfolio. It's owned by the super fund, and that's where I put my contributions. Now, I need to make sure, again, this is just another layer of crap you have to deal with. I've got to pay my tax quarterly, the contributions tax. Like, it's just the accountant or the auditor may need to do the quarterly books and all that. It's just, so I would hope that if you are buying that property, Vanessa, that your SG contributions don't just get sucked up into paying the difference between rent and the mortgage repayments.
Yeah, that's right. You really do need to know your running costs in any property you buy, but more so in your super because it can whittle away pretty quick. But also for Vanessa, there is a percentage that we need to keep in cash anyway.
Well, as a responsibility, as a trustee, you need to make sure there's liquidity in the fund.
Is it 10% minimum?
No, there's no hard and fast rule. It was just some of the lenders did that, like I said before, on settlement, they require a 10% liquidity.
Yeah.
But it would be a good rule of thumb.
But didn't they have that previously? I thought there was a minimum.
I don't think it's mandated.
No?
But
okay.
But what you need to do, so for example, like we shared in the last video, and the episode just before this, 836, not 836B, my insurance that was set up a million years ago is paid by super. So every year I do a rollover from my self-managed super fund into that insurance policy.
Yeah, okay.
So you need a few grand a year for your insurance.
Yeah. So I'll speak to this one for Lauren. SMSF for an investment property, please. We're looking into this and seeing if it's a good idea or not. I think we've spoken about the cons of it, I suppose. The high interest rates, the fact that you can't live in it, you can't get equity out, you can't do any major renovations to it or use your own cash for it.
The negative gearing sucks.
The negative gearing is 15 capped. So the holding costs, if I was doing this, Lauren, if you're sitting here saying, yep, I realise all the cons, but I'm going to do it anyway, it's got to be a one-part contract, so it's an existing dwelling, or if it's going to be new, it's got to be, I don't know, an off-the-plan apartment or something like that. Don't know about that either, but it's got to be high yielding. It's got to be, I think, 6% minimum.
Yeah.
Otherwise,
what are we doing?
Your costs, you're just getting chewed up with, and your contributions are getting eaten up each year. And yeah, in 10 years' time, it might look all right, but what's happened in the last 10 years, and the performance of it has to be solid. We're not just doing it for the sake of, I just want
buy
another
a property. Yeah. My cousin, she messaged me the other day. He's like, oh, how much do you need to buy property in super? I'm like, stop. Why do you need to buy property in your super fund? It'll cost you more. You'll be less diversified.
Yeah.
It's just all this other crap. Also, do what you want.
Yeah. So
I don't care. but I'm not doing it in that situation.
I like to play those conversations out to see where they're coming from. You're not as tolerant.
No, because I think what it is, Johnny, is in Australia, property and wealth are so closely linked.
Yeah.
So if I own a property, I'll be wealthy. I will make more money. I think that's the thing. And if I can just use my super to buy a property, I've made it. I've got an investment property. I think it's that psychology.
I agree partly, but I also think people look at their superannuation and say, whether it's fees or performance, and like, I thought it could do better.
Yeah.
So I'm bugger it. Impulse, I'm taking it out, or not even impulse, but I'm going to put it into property because that's what I trust. That's where I've grown most of my wealth because I bought this principal place 20 years ago and now look at its value.
But that just goes back to you don't understand what super is and how it actually works.
I'm not saying that.
Yeah, exactly.
I'm just saying part of their
I know
thinking,
that you're not saying that.
part of their thinking is,
That's right.
well, yeah.
It's an education thing.
So Adam, just
yeah.
quickly with him, that's a quick answer. Can you buy a house?
My name's John.
Can you buy a house with SMSF and when you retire, let's say 60, make it your principal place of residence? No.
Yes, you can.
You can.
Well, read part 2.
Once that is done, can you then get another job and not face any issues?
Yeah.
Get another job.
Yeah. So at age 60, if you cease employment or have a change of employment, you can withdraw 100% of your super. So what Adam is saying here, can you buy a house with your self-managed super fund?
Yeah.
Yes, you can. And when you retire, say 60, yes, what you would do in the background, move the super portion that's got the property in it to pension phase and withdraw it.
Okay.
Then you can live in it because it's outside of super. It's been withdrawn tax-free.
Yes, okay. I missed that bit.
Yes. Then you can be like, oh, the retirement lifestyle wasn't for me. I'm going to get another job. Yes, you can. There are some carve-outs with stamp duty that if you are doing that, you generally wouldn't have to pay, but check with someone who knows about self-managed super funds because I know my bare trust deed was stamped. So when it finishes and transfers, I don't pay stamp duty.
Sure, their governments have got their hands on that.
Well, but that's okay. So it's a change of ownership from the super pension to your new self. So you're withdrawing it. Look, I don't know that answer, Adam. I think if I was
surely it's not that simple.
Well, if I was a betting man, I would probably say there might be some stamp on that.
And he might say, well, okay, it's worth
$1 million. 30.
$1
Yeah, it's worth 30, 40 grand in stamp because I've just sold it tax free from pension phase.
Yeah.
So, yeah, take that one on notice. Actually,
there's a lot of thinking goes into that 20 years ago, doesn't it? It's like, I might be living here when I turn 60. That's what I'm thinking about doing. So I'll just buy there just in case.
Now, other reasons why you might have a self-managed super fund. You might want to invest in things that you can't invest in on your retail platform. You might want to go to town on crypto or Bitcoin. I haven't seen many industry funds offering a crypto option because they are the trustee and they've got to have options that are to benefit their own members. We talked last episode about, well, if I just want AU ETFs and international shares, I don't think you need a self-managed super fund. My crypto account is owned by the super fund. Any other speckies or if I do any venture capital stuff, I'll probably just do it through my super fund now because it's set up.
Paintings, antique cars.
Yeah, so you can buy artwork, but you can't hang it in your house and look at it because that means you've withdrawn from super. You can buy vintage
commercial building that you've bought
I don't know about
super.
that. Yeah, mate, gosh. Ugh. And this is a landmine.
Yeah.
Like people invest in bottles of wine. There are limits with in-house assets, and we won't get into the weeds on that, but this stuff gets really complicated really fast.
They do like the flexibility of it in those type of assets to be able to come and go with those.
Yeah. Now, and to be honest, and I just didn't have my ducks in a row in time, but that commercial unit that we purchased, it was kind of flip a coin. I probably should have just bought that with my super.
Yeah, well, I got talked out of that.
Yeah, why?
I think, I think the lack of flexibility. I think it was just like, okay, family trust, why not?
Because so basically, and this is a way that sometimes this is where Glen's going rogue. Everything I say from here, well, actually, anything I say is not gospel. Get your own advice, blah, blah, blah. You could, in theory, set up a unit trust, and this is where it gets complex really fast. Buy a property in the unit trust, get the lending through the unit trust, then have your self-managed super fund buy the units. That probably gets you around the LRBA. But that, my friends...
But you're not living in that, though.
No. It's an investment.
It's an investment, and your business could run out of it.
Yeah. No, but all I'm just saying is you could set up and some people have done this, and over the years, I've talked to accountants, they're like, no. Other accountants have said, yes.
Right.
You could set up a unit trust, own a property, 50% of the units owned by your self-managed super fund, the other 50% owned by you personally.
Yeah, that's right. Yeah,
so,
I've seen that.
But I know accountants that will not do that or recommend that for people. Maybe it hasn't been tested in court, but others are like, yeah, that's fine. It's all above board because of the unit trust structure and whatnot.
So the downside in our situation with that commercial was if we were to sell that,
the money's stuck in super.
Money's staying in super. That's the problem when you're only a young bloke like me.
Yeah. So John and I bought a commercial property in a unit trust with other people, and we all lent money in. And at the time I just was like, I had too much going on. So I'm like, I'll just do it through the trust, not the super fund. But, if we go again, who knows? But, and that's it. Like my structure's set up so I can use it now to optimize. But just in finishing, trustee responsibilities, you've got to always ensure that the sole purpose test is met, and that's running the fund only to provide retirement benefits or death benefits to dependents. You've got to make sure that the trust deed is basically operated explicitly that way. You have to comply with the SIS Act regulation, tax laws, and the Corps Act. You have to have an investment strategy, review it regularly. You have to consider diversification, liquidity, risk, member needs, and insurance for members. You have to keep your SMSF assets separate from your own personal shat. And that's what I'm like, because I open my Macquarie app, got all my SIMO stuff in there. It's got a super fund cash account. It's got another entity cash account. I'm like, friggin' hell, I've got to be careful.
Don't make the wrong transaction.
Yeah. You've got to ensure assets are valued at market each year. Record keeping, got to do all that usual crap. Trustee decisions, maybe 10 years, financials 5. You got to do all your tax on time, GST if applicable.
A good advisor can take you through all that.
Yeah, and I will say they are absolutely flexible. So if I, for example, put in some money paid myself more through the business and Xero or the bookkeeper sent in more SG, and at the end of the financial year, $35,000 was put in as an SG. Well, at the end of the year, it's just a really easy fix. 5 of that's going to be personal, non-concession. It is flexible for stuff like that. So
hopefully this has given listeners a chance to
not do it.
Look at the pros and cons. And if you're coming in with rose-coloured glasses and it's confirmation bias, at least there's a few of these things to think about and talk to someone that knows your situation.
Yeah, but
that knows your situation that is not biased towards something.
Yeah.
Right. It's
level. Yeah. Most people, most of the time, will not need a self-managed super fund. If you're like, I just want to invest in crypto it's a bigger discussion because I don't think you're going to have 100% of your super invested in one asset class. I mean, the property people do it, which, again, I don't do all in one asset class. Those who live by the sword die by the sword. And if you invest a different way than traditional portfolio and all that, you'll get a different outcome. Now, the outcome could be
great.
hourly, good, different, or it could be a freaking flush. So just be very, very careful. So I hope that has annoyed you, everyone. Feel free to send this to your accountant. Send me an email, team@moneypodcast.com.au. If you want to insult me, go for it. I'm not a self-managed super fund specialist.
Nor am I.
You need to get one. But this is just a high-level thing. John Pidgeon from the This Is Property Pod Vegas. My name is Glen James, and you've been real. See you, John.
Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.